So let's look at now how the opportunity investment model works, okay? The whole idea, the point of the model is really to find an estimate for ROCC, for our opportunity cost of capital. And it does it like this with 3 steps. First thing is we have to define our investment mission. So what do I mean by that specifically? Here are 2 really good examples. One investment mission could be we invest in short-term securities with strong contractual guarantees. So that would be something like 1-year treasuries or CDs, very strong contractual guarantees, guaranteed directly by the Treasury Department of the federal government here, and guaranteed by the FDIC, which reports to the Treasury right here. Another example, another very different mission could be this. We invest in high-risk, long-term asset-backed securities. So that would be something like subprime mortgage-backed securities. These are actually some of the types of things that got us into trouble in the Great Recession. But nothing wrong with investing in these if you keep your wits about you. That's our first step. So our second step is once we know our mission, we want to find an opportunity cost investment that's compatible with that mission. So what's an opportunity cost investment? Another definition here. So this you need to memorize this. An opportunity cost investment is going to be a diversified portfolio of known projects with market or industry risks that fit our mission. So let's be specific about this again. Let's first of all think about what we mean by a diversified portfolio. You may remember, you may have seen in your statistics course that once you get a sample size of around 30, all of our statistical and probabilistic stuff tends to work pretty well. So we're going to say diversified portfolio is going to be a set of 30 or more projects, and in any given time period here, the returns of each project are not going to be identical, and the returns of one project can't be completely predictable from the returns of any other project or the overall portfolio of our 30 project or more portfolio of those returns. So that's really what we mean by diversification. And in a chapter coming up, we're going to define diversification mathematically. But for right now, this qualitative understanding is perfect. It's all we need, okay? So say about 30 or more projects, the returns of each project, annual returns, say, they're not identical, and we can't predict the returns of one project completely from another project in the portfolio. So why we need a diversified portfolio of our mission compatible investments. This is a great important graph which illustrates this. This is a really, really helpful graph. If we take a graph like this, where on the x-axis we put the number of projects we have in our project portfolio or our investment portfolio, and we measure risk up here on the y-axis. And I'm not even going to be specific right now about how we measure risk. It could be, we could define risk as risk of a loss. We could define risk as a return of 10% or less, something like that. We're measuring risk of our portfolio in some way. And what you see here is as we add more projects to our portfolio, our risk goes down as long as we're adding not completely correlated projects to the portfolio. Okay, so if we just have one project in the portfolio, we have maximum risk. And by the time we get out to about 30, we've reduced our risk by really about 50%. Okay, so what's up here? This is our project-specific risk. And down here, our systematic risk is our market and risk-free risk. Okay, and I'm going to say market/industry because it could be market or industry. So this is a really awesome thing. And what this graph implies is that all smart investors invest in diversified portfolios. So just going back to the Lukoil example, for example, Lukoil's not going to have just one gas station. They're not going to have gas stations only in urban areas. They're not going to have gas stations just in the state of Arizona. They're going to be diversified by geography. They're going to be diversified by urban versus at least suburban. They're not so big in rural areas, et cetera, et cetera. And they're going to have a lot of those gas stations. So that makes them diversified. If we're a stock investor, we're not just going to buy, we're not going to put 100% of our money into Tesla. We're going to put some money, if we like that really risky stuff, right? We're going to put some money into Tesla and maybe all of the FANG stocks, the Facebook, Amazon, Netflix, and Google stocks, something like that. And then hopefully many more of those tech companies to get us up to 30. So that's the story here, and very important, very helpful. Okay, so let's look at an example of what an opportunity cost investment could be for our short-term strong contract investor. Remember that was the treasuries or CDs, something like that. So the opportunity cost investment for her could be a portfolio of short-term CDs or money markets, and that would be great for her. And so how could she go ahead and construct this? This is why, one reason why the opportunity investment model is so good, because you can actually go out there and construct this portfolio. Okay, so she could do it herself. She could go to bankrate.com, for example, and look at the pick 100 CDs, short-term CDs that were available at bankrate.com and say, okay, that's my portfolio. Or what would be even easier, and what I would do because I'm so lazy, is I would just say that the opportunity cost investment would be shares of what's called the Mint Exchange Traded Fund. This is something you can look up at Google Finance or Yahoo Finance, and it invests in about 800 money market accounts and CDs. And here's a hyperlink for it where you can go right to its prospectus and see what it's all about. So how would that work? Would that be a diversified portfolio? Yeah, if we have 800, definitely. Is it in our investment milieu? Yes, her investment mission is short-term, very safe stuff, right? Something like treasuries or CDs, and we have money markets. They're as safe as, they're also protected by the federal government, as safe as treasuries and CDs. So money markets and CDs, that would be great. So that's our opportunity cost investment. You can find this, you can construct this in the real world, okay? And how about for our high risk, long-term asset-backed investor? For her, her opportunity cost investment could be something like this, a portfolio of subprime mortgage-backed bonds. Subprime just means, in case I haven't said it before, subprime means risky, okay? So it means that ultimately the folks who got a mortgage are at some risk of flaming out and not being able to pay back their mortgage. So this again could be a homemade portfolio, or again, if she was lazy and arguably smart, lazy like me and arguably smart like someone else, she could just say, my opportunity cost investment is going to simply be shares of the New York Mortgage Trust REIT. And how would that possibly be? Oh, this is its ticker symbol. Again, you can look at this at Yahoo Finance, Google. You can actually look up the company and look at them. And from the company, this is what the company says itself, okay? The New York Mortgage Trust is a REIT that invests in residential mortgage loans, including loans sourced from distressed markets, okay? That's high risk, right? Multifamily, commercial mortgage backed securities, okay, and subordinated loans. So this clearly is not perfect, right? Because it's not exclusively subprime mortgage backed loans, but it's very, very close. And the more you look at this company, the more you can see it's very, very, very close. So this would be a great opportunity cost investment for our high risk, long term asset backed investor. And on that note, let me just pause for a second, be right back. Okay, back in action here. So the third step in this model is, of course, finding out our opportunity cost of capital. That's the whole point, is this model is going to find for us the opportunity cost of capital given our investment mission. So the third step is really great. Our opportunity cost of capital is simply the compound interest or discount rate or yield to maturity, if we're talking about bonds, of our opportunity cost investment. So let's see how this is going to work for example, our short-term strong contract investor. Okay, so let's say she did choose, she's lazy like me, and she did say, my opportunity cost investment is going to just be shares of the Mint ETF. Then her opportunity cost of capital is just going to be the average interest rate for all of the items in the Mint ETF. And guess what? This is really great, okay? This information is available. This is published by PIMCO on a daily basis. And what they provide for this every day is they give their estimated yield to maturity, and that's R and ROCC for us. So what is this? This is a weighted average compound interest rate or yield to maturity for every CD and money market they have in their portfolio. And clearly this is going to change as CDs mature and they buy more and stuff like that. So every day this might change a little bit. Typically it's probably not going to change too much until we get to a time frame like month to month, something like that. So the wonderful thing about the Mint ETF is it gives us our diversified portfolio of stuff that's in our investment milieu, and it's easy to compute if we buy shares of that. This is actually the yield to maturity that we would get. This is the interest rate we would get from that fund. Okay, so the yield to maturity is R, or opportunity cost of capital in this case, and that's 2.23%. So you see this model gives us a really elegant, easy, clear way to get our opportunity cost of capital. All right, so let's see how this would work for our high-risk, long-term, asset-backed investor. Remember, opportunity cost of capital is going to be the average. We want the average of all the stuff in our opportunity cost investment. So in this case, now we're going to have to get a default adjusted interest rate or discount rate for her asset-backed mortgage bond portfolio, or if she is going to go with what I would recommend would just be shares of the NYMT, she needs the weighted average expected return of all the holdings that this company has after accounting for flameouts. Okay, why is this a little more complicated? This is a little more complicated because for this investor, the short-term strong contract investor, remember everything that's in here, all 800 of the things in the Mint ETF are guaranteed by the federal government. So essentially we don't have to worry about any of them going bankrupt or flaming out or anything like that, okay? But for the MYMT, some of them, these are very risky things, right? So some of the mortgage borrowers are going to go bankrupt. They are going to flame out, okay? So we're going to have to look at what the promised interest rates are, and we're going to have to think about how many are going to flame out, what happens if they flame out, etc. Okay, so here's how we do it. Okay, so the weighted average yield to maturity of all their holdings, excuse me, which we'd get from their latest 10Q report at the SEC's website. Okay, but this does not include flameouts. This is what we get if no flameouts. But clearly, these are risky borrowers, right? That's what subprime borrowers is all about. Some are going to flame out. So what we would do, we'd work for 2 weeks, no joke. This is a lot of work because we're going to have to dig through all of their holdings. And after 2 weeks worth of work, we'd say our best estimate is that about 80% of these holdings are going to perform okay, and they're going to give us that weighted average R of 12%. However, 20% of these holdings are going to flame out. 20% of the mortgages, those structured loans, are going to go bad and yield in our estimation of 0%. Okay, so in this case, we have to get the opportunity cost of capital as a weighted average of these two. Okay, so we need to take the weighted average. So that's going to equal 80% times 12% plus 20% times 0%. And if you work that out, I think you're going to get 9.6%. Let me just double check for us here. Equals 0.8 times 12% plus 0 times 20%, and that's correct, 9.6%. Okay, so when we're risky investors, we've always got to consider the risk-weighted average of our promised interest rates or discount rates here. We're going to have to think about this. This is a lot of work, okay? This is for professionals in finance, so clearly I would have to give you this information. I would say we've done the work, and we estimate that 20% are going to be fine, 10%, 20% are going to flame out, and then I could ask you to construct the opportunity cost of capital for this risky investment mission from the weighted average. Okay, again, final note here. As I pointed out previously, we did not need to adjust the Mint's published R because of those federal guarantees. There was no risk of flame out, right? Right. So that's why we didn't have to go through this exercise for Mint. So what are some important properties of our opportunity cost of capital? Again, know the definition. The opportunity cost of capital is our known interest rate for our diversified set of alternative projects with similar risks. All right, so remembering that, some important properties are, awesome property is we can make investments with this return, our opportunity cost of capital return, at any time. By what? By just adding to our opportunity cost investment position. So if we're the short-term, want to be super safe investor, we could just buy more shares of the Mint exchange traded fund, right? That would be great. And if we were the high risk mortgage-backed securities investor, what could we do? We could just buy more shares of the NYMT and enjoy our 9.6% return. So another way of saying this then is that the opportunity cost of capital is the interest rate we forego by pursuing a new opportunity in our investment milieu, okay? This is also another macro econ definition, which applies perfectly to us. If you haven't had macroecon, doesn't matter. You'll find when you get to that class a similar definition for opportunity cost of capital. So this sort of suggests to us a great strategy for analyzing prospective projects, which we're going to call later the IRR method. But here's how it would work. It's very simple, okay? We ask ourselves the question, is the R I'll get on this project I'm considering bigger than my opportunity cost of capital? And if the answer is no, then if I have 100,000 to invest in this project, the answer is no. I'll just put that 100,000 to work in my opportunity cost investment project. And that would work extremely well. Okay, second property of opportunity cost of capital is that we've got to be careful that it does increase with the risk of our investment mission. So the opportunity cost of capital, we saw this for our safe short-term investor, is clearly going to be less than the opportunity cost of capital for our risky subprime mortgage investor. Okay, and this is true because we see this empirically in the marketplace and in our opportunity cost investments. Okay, and the third thing to remember is just a reminder when we're discounting, we're using those discounting equations with our opportunity cost of capital. We want to complement that with our project risk adjusted cash flows. This ensures we don't miss any risks. And also, it conveniently ensures we're not double counting any risks. All right, next page is gray. You can read about it if you want. Otherwise, don't worry about it.